Financial education often describes spending habits as recurring behaviors related to money outflow. These behaviors are not inherently positive or negative but are evaluated based on their alignment with a person's financial situation. One commonly discussed habit is impulsive purchasing. This refers to unplanned acquisitions, often driven by immediate wants rather than pre-assessed needs. Economists might observe this behavior in various retail environments. The financial impact arises when the frequency and cost of these purchases accumulate over time, diverting funds that could have been allocated elsewhere. Another observed behavior is the consistent purchasing of small, non-essential items, sometimes referred to as the latte factor. While a single purchase is nominal, the cumulative effect over weeks, months, and years can represent a substantial sum. Financial literacy materials frequently use this concept to illustrate how minor, regular expenditures can affect long-term financial aggregates. This is a matter of simple arithmetic. The daily cost multiplied by the number of days in a year reveals a larger annual total that might not be immediately apparent. Subscription services represent a modern category of recurring expenses. These can range from streaming platforms and media access to delivery services and software. A common behavior pattern involves signing up for services, often during a trial period, and then neglecting to cancel them when they are no longer in use. This leads to a steady, often unnoticed, drain on financial resources. The automated nature of these payments means they can continue indefinitely without active user engagement, contributing to a category of expenditure that some financial observers term subscription creep. Paying for convenience is another spending pattern. This includes actions like ordering food delivery instead of cooking, using rideshare services for short distances, or buying prepackaged goods at a higher price than their raw ingredients. While these choices offer time savings, they come at a monetary premium. The trade-off is time for money. Financial analysis would quantify this premium by comparing the cost of the convenient option to its less convenient, but more economical, alternative. Over time, a consistent preference for convenience can result in a significant difference in overall expenditure. The use of credit to fund a lifestyle beyond one's immediate income is a significant financial habit. This involves carrying a balance on credit cards or taking out loans for non-essential goods and services. The primary financial drain here is not just the principal amount spent, but the compounding interest accrued on the outstanding debt. Financial principles explain that when interest payments are made without significantly reducing the principal, the total cost of the original purchase can increase dramatically. This cycle can create a persistent financial burden, where a portion of current income is perpetually allocated to servicing past consumption. Brand loyalty, when it leads to purchasing higher-priced items without considering equally viable, lower-cost alternatives, is another habit with financial consequences. While brands can signify a certain level of quality, an automatic preference can preclude cost-saving opportunities. A comparative analysis would involve evaluating the features, quality, and price of a branded product against its generic or store-brand counterparts. Choosing the more expensive option by default, without this assessment, represents a spending habit that prioritizes brand over economic efficiency. Emotional spending describes purchases made in response to feelings such as stress, boredom, or excitement. The purchase itself is a coping mechanism or a form of celebration, rather than a fulfillment of a practical need. From a financial perspective, this links spending decisions directly to emotional states, which can be unpredictable and frequent. This can lead to budget inconsistencies, as these expenditures are not planned and can occur at any time, often without regard to the individual's current financial standing. Another behavior is the neglect of regular financial reviews. This involves not tracking expenses, reviewing bank statements, or maintaining a budget. Without a clear picture of where money is going, it is difficult to identify areas of overspending or financial leakage. Financial education materials emphasize that awareness is a foundational component of managing money. The absence of this habit means that other detrimental spending patterns may continue unnoticed and unaddressed, allowing small financial drains to grow into larger issues. Upgrading technology and other goods simply because a newer model is available, rather than because the current one is obsolete or non-functional, is a habit fueled by marketing and social trends. This upgrade cycle applies to smartphones, cars, and other consumer electronics. The financial cost is twofold: the expense of the new item and the depreciation loss on the existing one. Each upgrade represents a significant outlay of capital for a marginal increase in utility. Disregarding small debts or bills can also evolve into a costly habit. A small late fee, a minor parking ticket, or a forgotten bill can escalate through penalties and interest. If ignored for long enough, these small amounts can be sent to collection agencies, which adds further fees and can negatively impact one's financial records. This illustrates how inaction and disorganization regarding small financial obligations can lead to disproportionately larger financial consequences. Each of these habits, when viewed in isolation, may seem minor. However, financial analysis demonstrates that their cumulative and combined effect over an extended period can result in a substantial diversion of financial resources.